Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have a lot to discuss with the EIA show, given the amount of disruption that we had from the Texas freeze-off. What does that mean going forward? And then what do we expect, just given, once we start to get through the noise and start getting into more of a normal backdrop. So just to kick it off, we just want to look at, what's happening with the crude curve. And you can see, based on this highlighted line, that the whole curve right now is trading above 50. So if you just consider about what does that mean for hedging, what does that mean for protecting some of that cash flow, you can hedge pretty effectively through most of 2021 into some parts of 2022 above 55. Now, not to say that that they will or that the E&Ps have to, but you can get a sense of how they're going to be able to protect a certain amount of cash flow, given if you can put out puts, maybe some spreads, just to give some comfort, especially as we get back to some normalcy on the other side. Now, given each contract is slightly different, so this is just looking at ICE Brent crude net longs. Now, the chart hasn't been updated, but I have the data that's been updated, which shows that the ICE Brent volume climbed to 1.17 million lots on Tuesday. Open interest climbed to 2.766 million lots on Monday, which is the highest on record. Just to give you an idea of just how much people are really kind of front running this reopening, the inflation story. So this is really helping pull a lot of this, essentially the whole crude curve and market up, especially given the disruptions that we had in the U.S. and then, kind of ignoring some parts that we keep talking about with the physical market, which we'll talk more in segment 3. But just to give you an idea that there is a lot of movement happening right now on the futures front. And then when we look at Brent April-May spread, was up a penny to 89 cents. We'll talk about that more in a minute. And then when we look at Brent Dubai spread, unchanged, and Urals March weak in 2 cents. So we still have Brent Dubai at about at a positive $2.76, but we have Urals March, which went down another 2 cents to be a negative $1.70. So we keep getting these wide swings, which we'll keep talking about, even though the total Northwest Europe or Ural swaps volumes was at the highest since January 25th, just to give you an idea of kind of the movements that we're seeing on all sides. And then when we look at the refinery outage, and we'll go through which ones and when are they going to come back, you get an idea of just what the disruption was on the U.S. side. So this is what we were saying last week when we predicted that there was going to be a build in crude, was that the hit to production was going to be less than the hit to refining. And we had about 5.5 million barrels a day of refining go down and about 2 to 3 million barrels a day of crude go down, and it could have been as high as 3 million at peak. But just to give you an idea of now, the refiners are slow coming back, where some of the production has come back, where we still are missing about 500,000 barrels, 500 to 600,000 barrels of production, but we're still missing about 2.2 million barrels a day of refining throughput. So again, just to give you an idea of kind of where that standoff is, which is going to have a bigger impact as we go through the remainder of this week and then really into the first week of March. Just to get an idea of, before we dive into these numbers, we just wanted to look at the railway passenger traffic from China. So you can see that we were starting from a very low number, just to give you an idea of how few people were traveling during this time period. And here you can see what 2021 was and versus what 2020 was. And this is just because so many things were canceled ahead of Lunar New Year, just because of the outbreak of COVID, the aversion of moving about. So again, this is where we were already starting from a low number, where in last year, some people did travel because the outbreaks, not everything was closed, the outbreaks weren't well understood. So there was a lot of movement, even though it was obviously depressed. So now that just because we were starting from that lower base, we had a much worse number. And you can see how that gets reflected in China. Now, this has started to reverse. We'll talk about this on Friday when this gets updated, just because you can see that China has bounced up. And we'll talk about that in the economy show as well, where Europe and the rest of Asia has started to turn lower, as North America has really kind of flatlined after seeing a nice little rally with Pad 5 opening up and a bit more movement within the Northeast. Now, when we look at the crude builds, it was really driven based on pad 2 and pad 5. So we had draws in pad 1, and it's pad 1's at a fairly low rate. That should start to close the gap as we do get more imports coming through. Then when we look at pad 3, that's purely going to be a matter of where are exports, where are imports, and where does refining come through. So once we start to get to some normalization, we'll see some draws come through this week and into next week, just because we have a makeup now on the export side. Imports will remain depressed, specifically into pad 3. So that's going to offset, and we do have more production, so the production will minimize what that draw is going to look like, just because we're not going to have the refining capacity to absorb it. So that's going to help fill some of the gap into the export world. So again, it's going to kind of go back and forth as to where is this going to go, but for the most part, we're going to have the draws continue as we go through this week and into next week. Now, when we look at production, it's not picking up the full downside, and it's not picking up the full upside. So just to give you a quick update, so U.S. drillers have restored about 80% of crude production. They peaked out at about 3 million, 2.93 million. And right now we have, which got to about obviously 600 to 700,000 barrels. So that's where we're sitting at this point, where we have, we're back to about 2.9 million off of the 3.5 million. That's normal, just to give you kind of that guesstimate as to where we sit. But that will start to close as we go through the end of this week. Now, when we look at excluding the SPR, you can see we had that small increase. But realistically, we're still above. We're still 19.7 million barrels a day above the year over year. We're now back above the 5-year average. Again, we're just going to kind of sit along this 5-year average at this point, just because we have these mitigating factors where we have some bearish and some bullish on each side. And then we'll go through how does this impact the products in a bit more detail. So then when we look at the inventory in pad 3, that obviously drew down. This is something that should see some continuation as Cushing was held back because we didn't get that flow through. And then the imports obviously got hit. So this is something where we're going to get a little bit of a reprieve, where some of this Cushing flow will start to come down, but the imports will remain a problem, especially given how they try to marry with what the refinery runs are. Here's where you can see what Cushing did. So we had that bounce off of Cushing. Now, because we did get a spike back in production versus the refining throughput, we will see some pretty stable builds in Cushing. Now, it's not going to really accelerate all that much. It's just we're going to hold this line just because we're going to get the production going into storage, just because it won't be able to go into refiners as quickly. And then it'll be a matter of how quickly do we get those exports. We had some WTI price at a pretty wide discount that has now started to close. So and as we've been talking about over the last 3 or 4 weeks, we expect those exports to start to slow down, just because those purchases really pared back, both going into both Europe as well as Asia, which is going to impact how much exports leave the coast. Here's where you can see just how bad those import numbers were. So we were down about 1.3 million per day. And obviously the biggest impacts came across the board, but with pad 3 being the biggest of 533,000 barrels a day, pad 2 a decline of 262,000 barrels a day, and pad 5 a decline of 292,000 barrels a day. Now, 73% of the country had snow cover and some sort of inclement weather. So this had a big impact as to what was going to happen with a lot of these imports. Now, we'll start to see some of that reversal in pad 5 and pad 1, but again, it's going to take time to see what pad 3 does, because that's going to be a little bit of a benefit, or at least a bullish side of drawing down some of those storage, because that'll be slow. And then pad 2 will start to recover as we get a little bit of an increase in capacity. This gives you an idea of just how steep the drop was. We lost about 14.5% of refining throughput, going from 83.1 to 68.6. We'll see some of that come back, but not all of the downtime is reflected in here. So we're going to kind of hang around this 70 to 73% through this week and into next week as we try to get some of this capacity back. Now, pad 2 will come back a bit more. So that'll have some recovery factor. It's just PADD 3 is going to struggle to bring back some of this capacity. Now, when we think about the capacity, this is just some refining throughput that we can talk about. So this is what was confirmed down, partial impacts, and then what is restarting. The problem is the restarting side. Guys have said that there's going to be about 2.2 million barrels a day. That's going to take about 4+ weeks to come back. So out of that 5.3 that is restarting, assume about 2 million to 1.7 to 2 million will take a little bit longer. And that's going to be that residual that's going to bleed well into March and is going to reduce the amount of crude throughput, which will put a bit more crude in storage versus what should be. Not to say that we won't still see some draws just given the export market, but it'll also help pull some capacity for refined products out of storage. But we do have essentially like a floating armada coming from both Europe and as well from Singapore and South Korea coming over, which will help kind of insulate some of those impacts. Then when we look at implied demand, it's not surprising to see a big drop just because we did have such terrible weather, and it was going to hit pretty much all across the U.S., especially big driving areas, which is really the Midwest, the South. You got hit the most because when we were talking from North Dakota down to Texas, you had this big deep freeze. So that wiped out. We also did have an elevated number last week. As we were saying, 8.4 million was more of a makeup number, and it was actually closer to something around 8.1. So that's why then we get this oversized move to the downside. Then we'll see a little bit of an oversized move to the upside. Distillate demand came down. This will start to normalize as well, as we were saying last week, just because there was a freeze through the Northeast. That has now abated. Last week was moving some of this heating oil into position. That has now pretty much been filled, and now the heating demand will start to diminish, which will hurt some of this diesel capacity. But we will have some movements back and forth that were caused based on what happened in PADD 3. Jet's going to, again, maintain its kind of downward trend, and then propane is the one that we'll see a little bit of a bounce back. But propane is one that we're going to talk about in more detail in both Segment 2 and Segment 3. This just looks at what are imports right now. So you can see that floating storage remains stable, as we were kind of saying last week. It's going to remain elevated as more boats show up, and there's still that delay on getting capacity into PADD 3 just based on downtime. And this is just what is supporting that factor. You can see how that imports dropped. We will get a bounce in imports, but it will stay well out of the bottom of the cloud and stay well below, just because of that timing on reactivation. Now, PADD 2 continued to move down. It's now back at the bottom of the cloud. This is one that will bounce back to about the 5-year average, just given where some of these movements are. Again, these are things that are just going to take inherent time as things normalize. Then when we look at the refinery capacity, you can see that we came down to that 2020 number back in April and May. There'll be a bounce. It'll still be well below the bottom of the cloud. It'll probably recover about halfway, most likely to about 73 to 75 as we go into next week, just given where some of the capacity comes back. Some of that downtime was realized. Some of the reactivation was realized in this number. The difference will be realized in next week's number. So again, it's just going to be that timing on when do we get this activation in this activity back up and running, because it was a hell of a freeze out there. So now it's just a matter of trying to sift through the noise, and we'll do more of that in Segment 2, and then going abroad, looking into the rest of the world in Segment 3.